Budget Part 2. Sales Budget. The sales budget is approved by the Budget Committee and describes expected sales in units and dollars. The sales budget is the basis for all of the other operating budgets and most of the financial budgets. It is important that it be as accurate as possible. The first step in creating a sales budget is to develop the sales forecast. The sales forecast is just the initial estimate and it will often adjusted by the budget committee. Okay, take a look at this example. Royal Company is preparing budget for the quarter ending 30th June. Budgeted sales for the next 5 months are April, May, June, July, August. So this is the numbers. The selling price is 10 ringgit per unit. So the individual months of April, May and June are summed to obtain a total projected sales in units and dollar for the quarter ended 30th June. So budgeted sales in units, selling price per unit, and we got total budgeted sales. All sales are on account. Royal's collection pattern is 70% collected in the month of sales, 25% collected in the following month of sales, and 5% uncollectible. The March 31st accounts receivable balance of $30,000 will be collected in full. So accounts receivable as at 31st March, 30K. And the April sales from the sales budget for April, 70% on the month of sales and 25% on the following month. Okay, so it's May in June. So we get the total cash collection, 905,000. Okay, the production budget. The production must be adequate to meet budgeted sales and provide for sufficient ending inventory. The production budget tells how many units must be produced to meet sales needs and to satisfy ending inventory requirements. To compute the units to be produced, both unit sales and units of beginning and ending finished good inventory are needed. So unit to be produced equal to expected sales. So the expected unit sales plus units in desired ending inventory minus units in beginning inventory. The management at Royal Companies, this is the example, wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. So let's prepare the production budget. Budgeted sales plus the ending, desired ending inventory. We get the total needs and then less with the beginning inventory. So we get the required production. So this is how it calculates based on the information. We do all for the rest of the month. Okay. Okay. After the production budget is completed, the budgets for direct materials, direct labor, and overhead can be prepared. The direct material purchases budget tells the amount and cost of raw materials to be purchased in each time period. The formula used for calculating purchases is as follows. Purchases equal to direct materials needed for production plus direct materials in desired ending inventory minus direct materials in beginning inventory. So the example, at Royal Company, 5 pounds of materials are required per unit of products. Management wants materials on hand at the end of each month equal to 10% of the following month's production. On 31st March, 13,000 pounds of materials are on hand. Material cost is 40 cents per pound. Let's prepare the direct materials budget. So the productions and then Okay, the material per units, and then we get the production needs. So the desired ending inventory, okay, add with the desired ending inventory and we get the total needs, and less with the beginning inventory, we get the materials to be purchased on April. Okay, so the ending inventory, okay, 10% of the following month's production needs, as mentioned in the information. So, okay, let's see. Okay, we calculate for other months also. Okay, so the so the ending inventory here will become the beginning inventory in May. So is the other month. Okay, so we get the material to be purchased. Okay, Royal pays 40 cents per pound for its materials. One half of a month's purchases is paid in the month of purchase, and the other half is paid on the following month. Okay, the on 31st March accounts payable balance is $12,000. Let's calculate the expected cash disbursement. So account payable 12,000. Okay, so in April, okay, this is what we calculated earlier, and then times with um, 40 cents per pound, and we get 56,000 and 50% as mentioned in the informations previously. Okay, right. So we calculate for other months, and we get the total cash disbursements of 180,000. Okay, the direct labor budget shows the total direct labor hours and the direct labor cost needed for the number of units in the production budget. The budgeted hours of direct labor are determined by the relationship between labor and output. So this is the example. At Royal, each unit of product requires 0.05 hours, that is 3 minutes of direct labor. The company has a no layoff policy, so all employees will be paid for 40 hours of work each week. In exchange for the no layoff policy, workers agree to a wage rate of $10 per hour, regardless of the hours worked, so no overtime pay. For the next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. So this is the guarantee hours. Okay, so let's prepare the direct labor budget. So units of productions, okay, for April, May, and June. Okay, direct labor per unit, okay, 0.05, and we get direct labor hours. Okay, so the guaranteed labor hours is 1,500 hours. Okay, even though during April is less than, but we have already guaranteed to pay not less than 1,500. If it's more, then it's okay. If less, then we still put 1,500 according to the information. Alright, so hourly rate is 10 ringgit, and we get the total direct labor cost for each month. The overhead budget shows the expected cost of all production costs other than direct materials and direct labor. Many companies use direct labor hours as the driver for overheads. Then costs that vary with direct labor hours are pooled and called variable overhead. The remaining overhead items are pooled into fixed overhead. So the example at Royal, manufacturing overhead is applied to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. Fixed manufacturing overhead is 50,000 per month and includes 20,000 of non-cash costs, primarily depreciation of plant assets. So let's prepare the manufacturing overhead budget. So budgeted direct labor hours, okay, for April, May, and June, variable manufacturing overhead, okay, $20, and we get variable manufacturing overhead costs for each month. Okay, and then fixed manufacturing overheads, and we get the total manufacturing overhead cost. So we will last actually with the non-cash cost of 20,000, and okay, we get the cash disbursement of for manufacturing overhead for each month. Okay, any finished good inventory budget, okay, £5 times 40 cents, okay, 0.05 hours times 10, and actually production cost per unit is for $0.99. So budgeted finished good inventory, what will be the ending finished good inventory? Okay, so ending inventory in units is 5,000. Unit product cost is $4.99, and we got the ending finished goods inventory of 24,950. Selling and administrative expenses budget. The selling and administrative expenses budget outlines planned expenditures for non-manufacturing activities. Selling and administrative expenses can be broken down into fixed and variable components. Items as sales commission, freight, and supplies vary with sales activity. So the example at Royal, the selling and administrative expenses budget is divided into variable and fixed components. The variable selling and administrative expenses are 50 cents per unit sold. Fixed selling and administrative expenses are 70,000 per month. The fixed selling and administrative expenses include 10,000 in costs, primarily depreciation, that are not cash outflows of the current month. So let's prepare the company's selling and administrative expense budget. So the budgeted sales, okay, times with the variable selling and admin rate, you get the variable expenses, and then fixed selling and admin expenses. So we got the total 80,000, and less with the non-cash expenses. So it's the May and June. So we got the total, okay, here.